think one of the things we found in trying to set this day up was that there's a lot of disagreement about terminology. What is impact investing? How is it different from ESG or from responsible investing, sustainable investing? And to what extent does it matter that we focus on any one of those particular areas when we talk about mainstreaming? And I wanted to ask you, first of all, how do you define impact investing? How do you feel it? Why do you feel do you feel it's more important than the other categories in terms of driving what really matters in terms of shifting the center of gravity of capital markets?
Sure. Well, first of all, thank you, Matthew, and to your team for bringing us here today. And it's just such a tremendous step forward for our field to have the economists shine a light on impact investing in this way. So really grateful for your leadership in that. Impact investing it's a big tent. It is confusing because it does incorporate many approaches to driving returns and driving impact. And there are folks under this tent that aren't as concerned with market rates of return, that are doing really high risk work that perhaps is not going to deliver the kinds of returns that many people in this room are interested in. And that's fine. I mean, I'll say, do what you want to do and find your investors and accomplish that. That is emphatically not what we do. We are driven by wanting to deliver really above market returns if we can. And we believe that there's no sacrifice. We feel that investing for impact across sustainability, gender, agriculture, financial inclusion, food, a variety of areas that you can have both, that you can drive top-tier financial returns for your investors, and you can drive significant environmental, economic, and social improvement in the sectors and regions in which you invest. And we put our metrics together very early on as a fund to really make sure that we're tracking that, because it's easy to track multiple on cash or IRR, the traditional financial measures. It's less obvious how to track your social impact, but we have a whole approach to doing that. So I think that because most people need to make a return on their investment, this part of the impact investing will become larger than the concessionary returns, just because more people are wanting to achieve both. And so certainly in the venture capital space that DBL occupies, everyone is looking for no concessionary returns and to do both. And fortunately now, 14 years in, we have lots of examples of how that can be done, including on this panel.
David, you do not describe yourself as an impact investor at all, but how do you look at this field and where what you're doing fits in, and also where you see the opportunity to scale?
Well, again, thank you for hosting us. I almost feel like I don't want to step here and step on the Economist logo or something like that. And it is terrific that if you had asked me 10 or 15 years ago whether we would have a conference like this, I would have said there's no chance anytime soon, and here we are. So we agree with Nancy in terms of how to think about investing, and would take add some nuance to what she was saying to say that, first of all investing has impact. And we need to recognize that whatever we're doing, we're having impact. And the question is whether we intend that impact or whether we're measuring that impact. We think of this field, and we would urge all of us to try to be as inclusive as we can and bring this into a tent so that it can in fact be mainstream. It's really quite important that we move away from thinking about different sort of silos and say, well, let's think of this as a movement, as a broader group. And we think of it as a continuum. So responsible investing, sustainable investing might be at one node. Then we would have maybe impact investing that is both return as well as impact. And of course, responsible investing has impact, but it's slightly more difficult to measure sometimes. And then you may have a node that is all about impact in some financial return, or just all about impact. And then, of course, you have philanthropy at one end. We would like to see the entire capital markets think of it that way. We would like to see the entire capital markets across all asset classes be investing in this way. And really, principally because the challenges that we face today are so significant, whether it be climate change, whether it be poverty, whether it be water challenges. All of these challenges are interrelated, and we need to mobilize business and capital to address them. Civil society, while important, and government, while important, alone can't address the challenges. And therefore, we need to collectively try to address it.
So you'd like to see the whole of the capital markets there.
Absolutely.
On that continuum. How far are we along towards that goal at the moment?
I think we're a long ways down the road because of in some ways, what Nancy said. There are a number of examples in this room of great businesses that are driving really interesting economic returns as well as important impact. And there's a lot of examples now of investors who are doing both. And so it's not a 5% or 3% niche anymore. It's something in the order of 20 to 30% of the market. And it can be more because there are great businesses that are leading this initiative. Investors are sort of catching up to these great businesses.
But we see these numbers like $60 trillion of assets have signed up to the United Nations Principles for Responsible Investing, but how much is there real serious depth to that commitment?
Well, there's certainly no question that there's double counting, and there's certainly no question that there's some number of investors who might be starting their journey, let us say, charitably the thinking about sustainability. But there's no question that the most significant, largest investors, BlackRock, for example, they're clearly focused on sustainability, maybe not so much yet on impact, although there's a terrific impact initiative in BlackRock. But the reason why, and the reason why some of the smartest and best CEOs is because it's the great way to drive long-term success of business. It's a great way to drive a long-term success of investing.
And I would just add that in addition to The Economist, which is obviously a huge media platform that's shining a light on this, you're seeing it everywhere. I mean, where I'm from, sort of the nation state of Northern California, TechCrunch, which is kind of our Bible there, yesterday did a huge article about how mainstream impact investing is and how it's going to grow and how VCs on Sand Hill Road will incorporate this into their work. And so when you see these kinds of media platforms paying attention, that to me signals popular sentiment.
I'd be interested to get Neil's perspective on this, but I mean, I remember Mark Andreessen famously describing impact investing as like a houseboat. It's not a house and it's not a boat. What's the point?
Although
I wonder how far.
We just co-led a deal with them, so I think we're all matching up.
But Neil, as an entrepreneur, do you feel the impact investing is going to become being a B Corp like you are and appealing to impact investors? Is that going to be the norm in future as people do startups?
I think so, but the question is, what's the driving force here? I think that you're going to start to see more traditional investors, right, follow in Nancy and David's footsteps, and you're going to continue to see more and more entrepreneurs, right, incorporate forms of impact and social mission into the core of their business. It'll be core to their brand, it'll be core to their talent strategy. It will just be the essence of the company. So then, the question for investors will just be like, hey, we're investing in these companies that already have this social mission. How do we evaluate it? How do we measure it? And is this a differentiating, aspect within the markets? And I would say it is, and happy to talk more about it, but it's core to our talent acquisition strategy. It's obviously core to our consumer brand, but it's not the main reason why people buy from us.
So what have you seen in the last few years since you've been in business that's made you more optimistic about where impact investing might go?
So I think we're living in an environment where there's a very tight labor market for skilled labor, and in particular for engineers, data scientists, product managers, UX designers, these key roles that every company, whether you're a tech company or not, needs and is under-resourced in. And when a company like us that designs and sells glasses, that lives within the fashion world, but also lives within the tech startup world, is competing with Facebook and Google for talent, will never match their monetary compensation. But what we do offer is the ability to feel like you're a successful, holistic person, that the work that you're doing every day is not just impacting the financial bottom line, but is helping people, whether it's reducing our carbon footprint or providing glasses to people in need in different parts of the world, or even here in New York. So, we now have over 1,000 people. My co-founder and I used to interview every single person that came through the door. Now we're not able to do that. But without a doubt, the reason why people come to Warby Parker is because of our social mission. And whenever we're speaking to other companies that are mission-driven, it's the number one reason why people go to work there.
Now, Roland, you, as a chief investment officer of a huge pension fund, I mean, you have a lot of influence in terms of how rapidly impact investing, so sustainability and so forth, move to the center of the capital markets. And we've seen a number of the Canadian pension funds very much involved in the long-term investment work that McKinsey and BlackRock have also been involved in, a number of other companies. How do you view this debate and where the stage it's at the moment in terms of where it was a few years ago, where it needs to go in the future?
Well, the debate is certainly more, center stage than it's ever been. And like my colleagues, thanks very much for inviting us and having the opportunity to share our views on this. And thanks for your kind words on the Canadian model, which I do think is one of the best in the world, both in terms of risk return, but also in terms of trying to have an impact on the rest.
And just briefly, for those who don't know, just how would you, in a couple of sentences, describe the Canadian models? What makes it different from?
Well, the three letters one is do it yourself. We do it ourselves in the sense that 90% of our assets are managed internally by investment professionals that are based for us in Montreal, New York, London, or Singapore. We do direct investment. We do a lot of what we call non-liquid or less liquid investments in private equity, infrastructure, real estate. If I had to nail it, today, an average equity investor holds their stock for 7 months. We hold them on average for 10 years. You can't really think of having an impact or even just try to take into account the impact you may have if you're trying to make money every 7 months. You need to have a longer-term investment to do that. We are lucky enough that our clients are long-term, pensions and insurance companies, so their liabilities, their needs are also in the long run. So we can align ourselves with them to do what we feel is the right thing to do. But first and foremost, we're there to do well. We're there to do money. We're there to have proper risk returns in funds that have, again, a very long-term horizon. So, I'd be a bit more, skeptical or maybe less hopeful than my colleagues on the way it has penetrated, the whole capital market so far. I've got hope for the future. And I certainly think that we have anecdotes every day of people who do invest with a minute, a day, or a week time horizon. You can't think of an impact when you do this. So the way to do it is to think the long term, to then again take your main competitive advantage at your disposal, which is for us time, and to try to use it at its best. And for us, it's having fundamental research, geologists, engineers working with us to understand the businesses we invest in, to align ourselves with the owners and the managers of those businesses to try to grow them. And hopefully, on the way, we'll have a positive impact, because as soon as you take a longer-term view, the environment, the social, the governance becomes a very important risk factor of your investment. If you want to make money by managing the risk, you need to take this into account. There's no choice.
And do you think that long-termism basically is what we're talking about here, rather than, is that a better phrase to use than impact? Or?
Well, I do think, I mean, I was trying to think of what really is impact investing on the web here this morning. I mean, I think it was mentioned before, the main difference between impact investment and any other kind of investment is the intent. You are trying to make money, you're not doing concessionary investment, but the intent is also to have a positive impact. For us, it's mostly, we have to look at the impact of what we do, because it is going to be an important part of our risk return. And there's a slight difference between doing it because you have to, or doing it because you want to. And we do it because we have to. And I think we have to because we're long-term. So in that respect, yes, long-term is probably our definition of having impact. You mentioned the focused capital on long-term initiatives that was pushed forward by BlackRock, McKinsey, and a few of us. We like to see ourselves as business owners, not investors. And as soon as you think of yourself as a business owner, you have to align yourself with people who are behaving like one, and that certainly requires taking into account all your stakeholders and not just your shareholders.
Nancy, how do you react to that? I mean, do you think impact and long-termism are pretty much the same thing?
I don't, actually. I mean, I do think a long-term investment horizon helps you build impact, because you can't turn everything upside down in a year or two. I mean, everyone knows about Tesla today, but no one knew about Tesla when we invested in 2005. And if they did know about it, they thought we were crazy and they laughed at us. So you do need to, these things take quite a while to germinate. But I think what Roland...
I suppose the Canadian model would be criticized for not doing enough venture capital investing.
Well, we certainly were not in Tesla in 2005 and had done for doing so. But I don't think, we probably would have been the ones saying you're crazy when you did. So had done. Yeah, I mean, you have to understand that we manage quite a big pool of capital. And VC is usually, to begin with anyway, small investments in quite a lot of funds. We can't do that because we have 800 people in our firm managing 250 billion. We'd probably need 80,000 people managing 250 billion if we did it in VC. But, again, as you said, there's different spaces in the market, and there's spaces for everyone. And certainly VC are necessary to help us get those companies when they're a bit further down the road and help them grow further.
Maybe we can talk offline. Maybe you should move a little earlier into the investment horizon, because it's in venture that you really can shape a culture. And you start with nothing. It's a clean slate. And so you can infuse impact from the very early days and have that grow into a big company someday. And so I think if you care about climate, if you care about gender balance, if you care about just place-based investing, which is how we started, trying to bring the benefits of the entrepreneurial economy to neighborhoods that need jobs. I mean, if those are the things you care about, then you can architect your company to be mindful of all those boxes you want to check off. You won't check them all off. I mean, you can't do everything with every company, but you can, through intentionality and through getting in early, you can help to shape a huge impact story. And Tesla is a good example. It's not coincidence that the Model S plant is in Northern California. That was a big struggle. It could have gone to Mexico. It could have gone lots of different places. But through parallel efforts among our team, working with Tesla, working with the state of California, it happened that it was able to site in Northern California, and now, of course, it's the largest manufacturing on the West Coast, I think, except for Boeing. So a lot of good things start to happen when you start early and you really want to accomplish certain goals.
I mean, it's interesting, David, I mean, in a way, you're largely, or I think entirely focused on public companies, public equities, large companies, and essentially screening out, the one that you think is in each industry, or one or two that you think are going to outperform because they basically get that sustainability and climate change are real things that they need to be positioned for. And so I wonder, what impact do you really have, and what, as you're essentially just avoiding the bad performers rather than changing anyone in what they do?
Right. Well, we do also have a growth business, and my colleagues would be sad if I didn't.
They have a phenomenal later stage private investment team.
Right.
Yeah, so that we do try to have impact in the earlier stage. But we probably wouldn't describe our process quite the way you did. We think that sustainability, environmental and social governance factors in our public market processes allows us to have a better and more holistic long-term assessment of what the possibilities of success of a business and a management team. And so we use sustainability as a lens to positively choose. In our case, we have 40, 45 positions in our public equity portfolio, the 40 or 45 best businesses we think that we can own subject to price. So, but of course, actually all active investors use a screen or use a process to narrow down their opportunity set. And we have said that ultimately the sustainability allows us to have a better, we think, a better and more holistic assessment of the probability of success of those businesses.
Because I guess it's said that if impact investing or this whole way of thinking is really going to have a massive effect in shifting the center of gravity of how the world's economies work, you've got to get public companies to change how they behave.
Yes.
And you know, most of the most interesting pioneers in impact investing are doing early stage, and that's going to take a long time if we're waiting for everyone to go public and become, you know, $50, $100 billion companies. It's going to take forever. And so, I mean, how do you change the public company behavior?
Well, so I think it's important to say that with very few exceptions, I think a lot of companies have they have a lot of things that they need to do different and better. And certainly large public companies would be very high on that list. Smaller, purpose-driven businesses, I think, have a better shot. But even those, Tesla has some things that they should do differently and better as it relates to human capital management, as an example. But there are, to me, the really interesting CEOs of major businesses have worked out that there are significant drivers of change in the world happening today, whether it be climate change, whether it be income inequality, whether it be water, whether it be health, whether it be how you operate in communities and build important stakeholder initiatives. These folks are taking an understanding of the drivers of change and then developing their products and services to address those drivers of change, whether it be in the transition to low carbon economy, whether it be healthy living, whether it be agriculture. I heard you mention Jason's initiative. These are long-term sustainable businesses, and large companies can and do, in fact, influence and get involved in those businesses.
Just as an example, for people to see kind of how you can do well on both the early and the later stage. I mean, if you're looking at diabetes, which of course is an epidemic here in the States with our children because of the obesity and eating patterns that kind of have been nurtured. You can, in the public markets, you could approach that by looking at a really ethical insulin developer that doesn't gouge people on pricing or has good labor practices or maybe has better dosing approaches that lead to less spikes and things like that. And so that would be a very worthwhile kind of health-related investment that addresses the issue of diabetes. At the same time, if you go early, you invest in something like a Revolution Foods, which is going into the low-income schools where the kids are getting diabetes more frequently and serving them, you know, a radical concept, healthy lunches, and developing those healthy eating habits from, you know, grade 1 on, and changing the nature of that disease profile. And one is not necessarily better than the other, but together they work really well because you've got to prevent diabetes, and it's hard to do that when you're selling insulin because that's your business. But on the other time, by the same token, you need to address the existing patients with an ethical, leading edge product that is fairly priced. So that would be an example.
Well, you can certainly also work with big companies, big agro-food company, to change the way they produce and deliver their goods. You know, we certainly think that you don't have an impact when you just leave the table. You know, we sit at the table and engage. I mean, we are a Canadian investor, so you can guess that we have quite a bit of investments in fossil fuels. And by the way, fossil fuels still account for about 85% of global energy sources in the world. And if we're lucky, and if we do a good job, by 2040, we'll still probably have 75% of our energy which will be produced by fossil fuels. So do we just leave the table and say not invest in fossil fuels, capital is very easily replaced, whereas influence isn't. So we've chosen to sit at the table, to select the best in class, so the few companies which we feel are better at acquiring their social license to operate, and then influence, work with them at the board, in committees, to make sure that they improve the way they do business, they improve the way they manage the stakeholders, they manage to improve the way they compensate themselves and align themselves with better practice that are at the end of the day going to be better for the world, but also better for themselves.
David, do you want to react to that? Or?
Which part?
I mean, with the fossil fuel.
Oh, that's what I thought you were getting at. Well, I'm
getting ready.
I would not hope that Roland is right, that in 2040 we still are using 75% hydrocarbons. And I think Matthew's probably heard me say this before. I think engaging is, first of all, sitting on boards, you can have influence in businesses, and there are lots of great examples of that. And it takes time, it's patient. However, if you're not sitting on the board and you're engaging with big businesses, you have to ask yourself, do they want to change? Are they able to change? Some businesses are able to change, in fact, make a transition more quickly to something more responsible, more long-term, something I think we all might welcome. Some, however, are not going to make a change. And engaging with them all day long is really not a good use of time, actually.
So in a moment I'm going to go to the floor, but I just wanted to ask each of you, if there's one thing that you think could be done that would dramatically lead to a step change in the mainstreaming of this way of thinking, what would that one thing be? I'll start with Neil.
I think that it's actually perhaps a crisis at some of these companies, because
which companies?
Any large public company, to provide more and more evidence that being thoughtful and responsible leads to better financial outcomes. Because I also sometimes take issue with the thought that it's always these small companies that are the ones that are being the most responsible. I think there's this belief if you buy a knitted hat at a flea market in Williamsburg, right, that is more responsible than buying, perhaps the same knitted hat from Nike or Walmart or Target. And most likely, there's much more rigorous social compliance programs at some of these larger companies that may have been from organic cotton. It may have been, it likely didn't use child labor and what have you. So there's a part of me that thinks if we were to be meeting 10 years from now, would we be calling this impact investing, or are we just calling it investing? And is that really what we mean by the mainstreaming? Because we talk about something very similar within retail, where there's this thought, oh, retail means bricks and mortar, and then you have e-commerce. It's like, no, and there's this buzzword, omni-channel and blended retail. If I can tell you 5 to 10 years from now, no one's going to use the term omni-channel or blended retail. Retail means both e-commerce and bricks and mortar. And it seems like we're on a very similar trajectory from impact and investing. I think if we just look at it in terms of capital allocation of people that call themselves impact investors versus how some of other aspects.
So in 10 years' time, what will it look like? It will be?
So when Warby Parker, we've raised $215 million to date. We only had one term sheet that mentioned anything about social good, and it was in fact just asking me to certify that we don't use child labor. I think if Warby Parker were to launch 5 to 10 years down the road, I hope that those term sheets would have a lot more constraints when it comes to environmental impact and social good.
Roland, you wanted to come in?
Yeah, well, I think a crisis, I was going to say a crisis always helps. There was Rahm Emanuel who said, never let a good crisis go to waste. Unfortunately, we've had a few crises. BP spent $60 billion, I think, in fines after the Deepwater incidents, and I'm not sure it has made much of a difference. I think what we need to do, and thanks for helping us do this today, is improve knowledge. CFA was created about 100 years ago. People have been analyzing the finances of companies for decades, if not centuries. We've only just started. So we need to improve the knowledge. We need to understand better how non-financial things impact the financial returns. We need to speak to people with what they unfortunately only think about, which is how much money I'm going to make, and then make them realize that there's an alignment. There's not an or, there's an and. You can actually make money and have an impact. And I think that, on this front, science, media, investors, they all need to get together to get people to understand that this is possible. You can rigorously, measure the impact of what you do, and then let people know that this is the way it works. So yes, crises are good, unfortunately, and we'll probably have a few more of these in the next decades, but certainly improve knowledge.
But do you think that involves spending more on the analysis?
Well, we do. I mean, we have big research teams, some of which only focus on those part of the studies. When we look at a mining company, I mean, how sustainable is that? Well, there are a lot of mining companies in Canada. How do they buy the social license to operate? How do they manage the local communities in which they invest? How do they manage resources? We need to understand this. And to understand this, we don't need CFAs. We need geologists. We need people who have been involved in local politics. We need anthropologists. So we have to think of different ways of studying the companies we're investing, and that means having different teams and different, again, diversity, we mentioned it en passant earlier, is a blessing for the way we do our job, and diversity also implies having diverse angles to analyze and then, manage portfolios.
David, the one thing you would
we need to make the business case much more strongly and effectively. And we probably, actually, all of us should make it our business to engage with folks who aren't in this room. We often will convene our sustainability folks, and we all agree, but we need to go more broadly than ourselves and be focused on why this makes sense for businesses and why, therefore, it makes sense for investors.
Nancy?
I would say, and Roland, don't take this personally, but we need more people to jump in. I mean, DBL has been around for a long time. We're fortunate. We were oversubscribed in our last fund, which is a large fund for a VC, $400 million. There are so many talented managers out there that haven't been around for 14 years that go through many, many hurdles to get their first and second funds together, and it's just way too difficult. We're creating the 21st century icons in this asset class that are replacing the 20th century leaders that were good at the time, but are in fossil, or they're in junk food, or they're they're in chemicals that aren't leading to a sustainable agriculture. I mean, there's just a whole lot of problems that our 20th century and even 19th century companies like Monsanto and John Deere they've left us some problems we need to solve. That is a huge opportunity. We can create those icons that address 21st century needs, like a Tesla, like Nest that was sold to Google that Generation was in. But we need people like Roland to not sit on the sidelines and take some risk and really jump in and fund the managers out there. Don't just come to DBL or Generation. We can help you develop these portfolios. And fortunately, there are fund of funds with impact as a lens now that are being created, which will take care of you can't allocate small dollar amounts.
I'm sorry I'm sitting on the sideline, but I didn't pick my chair. Okay? I was just the last one in.
So I'm just, you're so much more progressive than a lot of the other major pension funds and institutional investors out there. This is a once in a lifetime opportunity, and there's so many people I see in this room that have amazing track records and funds, and we just need to support one another.
Hi, I'm Chris Fowl from the UNPRI, and I love the comments regarding education and getting more people to jump in. I'm wondering, what do you think about as a first step for those that might be in the room or outside the room that we want to engage with, more mainstream investors, so to speak? What about having them identify what they're already doing within their processes for integration of these issues and opportunities that match some of the language that this that this niche is using? Do you think that's an effective first step that might be a way for them to get started?
You want to take that, Roland?
When I start, very good point. And I said earlier that we do it ourselves. We actually manage 90% of our assets in-house, so there's another 10. And you're talking about 10% of 250 billion, so that's quite a bit that we manage with external partners and that we partner with to manage things that we don't know how to manage. And with all of these, without any exclusion, without any exception, before we partner with them, we ask them, how do you deal with that? How do you integrate the non-financial impact of what you do in the way you're building your portfolios? Again, when we look for partners, we always look for partners who are like us, long-term, quite concentrated portfolios as well, and people who invest in companies because they like the business, not just because they're going to like the next quarter of earnings. So again, we're trying to align ourselves with people who think like us. But I'll give you an example. We don't know anything. I don't know anything about Indian equities. So we do manage Indian equities, but for this we use a local portfolio manager who's great, who's been around for years and who does a great job. But he was investing in a company that was building a mine elsewhere in the region for which there was huge potential impact on a population of tigers that were about to disappear. And he didn't even know that, and we got, because we're very transparent, our annual report every year has got the whole list of all our holdings. And I can tell you, every year when it comes out, quite a lot of local journalists jump on it and say, okay, where can I get them this time? So, we got a question by an NGO on this investments, and we engaged with our portfolio manager. We had a lot of conversation with them, and they eventually decided to divest. So yes, influence goes beyond just what you do, but also what you get people to do. But again, let's not forget that it is important to have a long-term view. And if you don't, you can't just take impact in any really positive way.
Now, we have a couple of questions from the app. Considering the challenges to measuring social impact, how do you measure social returns, and are there particular indicators that you're looking for when considering investments with social impact? And we've got a whole panel on this later, but why don't you quickly give us a rundown?
When we started, there wasn't really any. There was no GIN. There were no guidelines. But fortunately, the Ford Foundation worked with us, one of our first investors, to develop metrics, and we have added a little bit to them over the years, but they've been fantastic. And we started as a place-based approach, as I said earlier, trying to bring the benefits of job creation, quality job creation, to low-income neighborhoods. That was kind of the thesis of the Ford Foundation's original interest in us. Then we later on things we wanted to do. We wanted sustainability, looking at carbon avoidance. We look at gender representation. Obviously, venture-backed companies are predominantly male in the U.S., and so we wanted to see if we could track that. We look at the entry-level jobs that we create and the career path. So we have both quantitative and qualitative metrics that we report on now once a year to our limited partners. And we have a body of work now for over a decade that really where you can see the actual impact, where things didn't work so well, but then, I think our original goal was something like 3,500 jobs to come out of our first fund. I mean, it's more like 35,000 because we had Tesla and Solar City and a whole bunch of big job creators. So we're firm believers in that those measurements have helped us to refine and go after new opportunities.
What about you, Neil?
I think from an investor perspective, the question is, hey, if we want to really mainstream this, to the earlier point of the panel, how do we tie these social impacts to financial performance? And as an operator, what I'm seeing is that the biggest impact is on talent recruitment and retention. So while a lot of people think, oh, this is going to help me sell more widgets, or in my case, more glasses, people are still purchasing products based on price, based on quality, based on customer service before social impact in most categories. So if I'm looking for the financial impact from a talent recruitment standpoint, how do I get better at people analytics? And Google's best in class in this. Wharton has just launched a people analytics initiative. Believe it or not, one of the things that's really hard to measure is retention. especially at a high growth company where you're constantly hiring new people. And the question is, you want a certain healthy amount of turnover, but if we want to show that, hey, we're able to retain our best people because of our social mission, right? How do we necessarily do that, and how that links
you have
to
metrics
financial
to show
performance?
that.
Yeah, so that's what we're working on. It's by no means perfect. And then the question is, how do we measure our social impact internally so that way we can optimize it? And that's difficult, and we have different protocols for each area of impact, right? There's no gap standard per se. So when we're distributing eyeglasses to people in need, we're looking at how long they wear them, what their age is, expected income. We're now distributing glasses as part of a program in Baltimore, in which we've partnered with the city of Baltimore and Johns Hopkins to do a 3-year longitudinal study to figure out the impact of glasses on middle schoolers on reading scores. So the problem is that we're going to have all this disparate data that is specific to the specific programs that we have, and I got to imagine that that's going to be very difficult for investors to roll up and aggregate across a portfolio. So I don't have the solution there. I can just tell you from an operator perspective, we're looking at ways to just optimize the work that we're currently doing.
And again, if you roll it forward 10 years, what do you expect that conversation to look like?
I would expect that I'd be sitting at the table, or maybe if we're a public company, have an earnings call and be able to say, hey, our our glasses distribution program has helped X number of children, and this is going to result in these states' education funding being more optimized because fewer people are going to get misdiagnosed as special needs because they have glasses that they need, that reading performance is up. So potential income is up by this amount. As part of our other distribution that we do in the developing world, we've created this many jobs and created this much increased productivity.
David, how do you view measurement?
Well, it's critical. If we're going to have something called impact investment, we will have to develop the tools to measure. And I would say, if you had asked us if there are 2 things that we can do to drive the mainstreaming of impact investing, one would make the business case, the second would continue to invest in how do we think about measuring impact. And as Neil was just saying, there's multiple ways to do it. It's important that, frankly, it's important that we begin to ask the questions, and we're going to see that evolve over time. And what drives the success of one business may not be quite the same as what drives the success of another business, and it'll be critical that we recognize that holistically.
Roland?
We don't, and that's the problem. We don't really measure it. We write stories, because we can write good stories about good investments, and I think your story is a great story. So as more stories go on, we need to find metrics. Everybody knows in the room, I think, what a PE ratio is. Price earnings, that's been around for decades, and we can talk about PEs endlessly. But what is the PE of a non-financial, impact of an investment? There's probably no straight answer to that. In today's populist world, it's very nice sometimes to find simple answers to complex questions. This is a complex question. We need more research. We need more knowledge, because I don't know how to measure this.
So just to give an example of how important metrics can be, gender, we didn't measure that in our early days. I told you about all the other things we measured. Many years ago, we were sitting around our conference table, and I said, wow, we have a lot of women CEOs in our portfolio. How many do we have? And they said, so we figured out it was like 26%. I said, wow, is that good or is that bad? And then I said, well, what's the national average? And back then it was 2.6%. So this is a shockingly low number, but so we were, order of magnitude. And so from that day on, I said, we are going to measure this. And now in our most recent fund, it won't stay this way most likely, but out of our first 11 investments, we're at 60%. So if we had not started measuring this, we would never have known, and we would never have driven for that improvement. So it's really important.
Great point. Our time is pretty much up, but I want to end by asking the graduate question. In the graduate, the tip was plastics. For each of you, where do you think the most interesting impact area for investing is going to be over the next few years? Roland?
Public transportation.
Public
You know, we need to enhance productivity. Transportation infrastructure is in a dreadful state all over the world.
And you guys are directly building a...
Well, we actually are, yeah. We are building a train that, for anybody who's been to the airport in Montreal now will know that there is a need for better infrastructure between the airport and the city. So we are building a light train that's going to be, you know, up to standards in terms of environment, social, and productivity impact. And we certainly think this is a very impactful way of making return and making a difference.
David?
Broadly speaking, the transition to low-carbon economy.
Neil?
Anything related to urban development as trends and people continue to move into cities.
I mean, you're asking me to choose a favorite child. I mean, obviously, the low-carbon economy, but also food and agriculture and the way that intersects, and financial inclusion.